Here we are in June 2026, and investors are navigating a set of complex macroeconomic, geopolitical, and market forces. We have a new Fed chair, a midterm election in a few months, at least two wars going on in the world, and oil flirting with $100 a barrel. Whether it is this set of conditions or others that are just as challenging or more benign, we here at Guggenheim Investments lean into structured credit as an important allocation in most of our fixed income strategies. Why has structured credit become such an important differentiator in how we approach active fixed income investing and the allocations and return profile of our portfolios? It's a big topic, and we have a two-part episode to address it. I'm Jay Diamond, Head of Thought Leadership for Guggenheim Investments, and I will be in conversation with Karthik Narayanan, Head of our Structured Credit team. Now, part one of our two-part episode addresses the fundamentals of structured credit investing and why we believe this sector is attractive on an absolute and relative basis. Part two will explore the opportunity set and risks in current market conditions. So with that, let's get started with part one. Hi, Karthik. Welcome back to the podcast, and thanks for taking the time to chat with us today.
Thanks, Jay. Happy to be back.
All right. Now, I know we always start with this question. We have you on, Karthik, but it is worth asking again for our first-time listeners. In plain terms, what is structured credit or asset-backed finance, which another name by which it's called, and what types of assets sit behind structured credit?
It's true that in structured credit or asset-backed finance, there's a lot of ambiguous terminology. So it's a good thing to start with sort of level setting on what are the acronyms or the principles and basic ideas to help our listeners cut through the noise and some of that jargon. So the broadest term is asset-backed finance or ABF. So that is basically secured lending in any form on contractual cash flows and assets. There's no hard and fast published numbers or estimates at something like a $25 trillion market. A lot of that is government guaranteed. Some of that is real estate related. If we take away the 10 or 11 trillion that is government guaranteed and look at the remaining credit market and take away loan form investments and only focus on securities like tradable bonds, we're talking about something like 3 to 3.5 trillion of what we typically called structured credit. So structured credit, if you want to think about it very simply, is the tradable bond part of the broader asset-backed finance market. Now, what are all these financing instruments? They're really any kind of debt that's secured by contractual cash flows as well as a pledge of assets. The other thing that's common within structured finance or the structured credit tradable bond part of the market that we tend to focus on is that in addition to that pledge of assets, there are a number of bondholder protections that reduce the likelihood of loss if something goes wrong.
And what types of assets or underlying contractual cash flows are we talking about here?
It's a very wide spectrum. So we take the four major food groups of structured credit, which are asset-backed securities, collateralized loan obligations, residential mortgage-backed securities, or commercial mortgage-backed securities. Those are backed by either mortgages on residential properties, mortgages on commercial properties. In the case of CLOs, they're backed by a diverse pool of senior secured loans to non-investment grade companies. And in the case of ABS, they're backed by a diverse range of contractual cash flows, such as aircraft leases, leases on maritime shipping containers, auto leases, royalty streams, and the list goes on and on. So it's a very diverse technology as opposed to a narrow asset class.
Karthik, as I said at the top, structured credit or securitized income or asset-backed finance, it's a common feature of how we manage total return portfolios. So what is it about structured credit that has made it such an important sector for us and our clients?
It's true that structured credit has played an important role in our portfolios, and it's really because at a high level, we have viewed and continue to view it as offering better risk and return trade-off than the more liquid fixed income sectors such as investment grade corporate credit. Now, that's a fairly generic statement, but I want to elaborate on that. We think there's a persistent sector level structural type advantage within structured credit. And the magnitude of that advantage will ebb and flow, and the riskiness will ebb and flow. But what we're saying is in the long term, we view this sector as having incremental yield per unit of risk. Now, there's a couple of reasons why this sector has been so favorable for us and why that relative value view has emerged. First is on the risk side. Historically, structured credit has experienced lower default rates than more liquid debt markets, such as corporate credit, for a given rating category. So, especially when you look at the investment grade level, the historical probability of default and probability of losing your money through default in structured credit for a given rating category is lower than in corporate bonds. Now, this matters because unlike equities, which could go up or down, bonds generally can only go up a little bit and they can go down a lot. So, really, as a portfolio manager, what you want to get paid for is grinding out better returns over time and not giving it away very quickly on a few bad positions. Now, second, because there are contractual cash flows, structured credit instruments tend to be intermediate duration. They don't tend to be as long as the types of debt instruments you see in the corporate bond market or in infrastructure or other sort of very long, type of obligations. They tend to be in the 3 to 7 year maturity range. Part of the reason for that shorter maturity is because there is amortization, which is bondholder friendly. It's taking out your risk audit passively over time, which de-risks the position. And the second thing is a shorter maturity debt instrument, there's lower spread duration or prospective mark-to-market volatility of return. So from a portfolio construction standpoint, you have A, instruments with a lower likelihood of default, and then B, you're able to invest in that part of the market without having to extend duration far out the curve and pile on either interest rate duration or spread duration risk to get there. The third factor is a complexity premium. So this is shifting more from the risk side to the return side. The complexity premium is what I would call an efficient amount of inefficiency, where investors are getting paid to do more work to analyze complex documents, payment priorities, cash flow waterfalls, bondholder rights, and pledges of assets. You require more work to understand investment. You certainly want to get paid more. So I think that's a basic premise there. So you put all that together, you have lower default rates historically, intermediate duration and potentially lower mark-to-market volatility and higher yields for a given level of credit risk. That's really what our favoring of structured credit has revolved around. Now, all this sounds great. How you actually access and monetize this excess yield per unit of risk is very important. The execution is very important, and it's something we've spent a lot of time here building a platform process, guardrails around, as well as opening the funnel to see the broadest potential range of opportunities over time so that we can fish in the biggest ponds.
So you mentioned the complexity premium and how you monetize it, if you will. Does it take any particular expertise or experience to be good at taking advantage of it in this way?
I think being involved in structured credit has been a hallmark of what we've done as fixed income investors for 20 plus years. There's, obviously a deep knowledge of structures and robust analytical toolkits. And this is a big commitment. It's a commitment the firm has made and kept over a long period of time. And it restricts the ability of tourists in the market to earn returns without elevated volatility over time. You may not see it month to month, but you will see those differences in the long term. And so credit first is kind of the way we're approaching things. Now, there's a couple of differentiators, what you asked about. I think one that's maybe a little bit underappreciated is you have to have access to a broad array of deals. I think a fundamental premise in investing is you want to see a lot of deals so you can say no to a lot of things. And say, if you say yes to 10 things out of 100, those 10 things are going to look better if you're rejecting 90 than if you're saying yes to 10 things out of 20 things and rejecting 10. So how do you gain access to a broad array of deals? There's sort of a broad range of models that can exist there. One is sort of the classic, bond trader archetype where you're sitting by the phone waiting for Wall Street dealers to call you with the next syndicated deal. A lot of business gets done that way. There's nothing wrong with that. It's an efficient way to access the market, but it's limited. You only see deals after they're fully baked, when it's a proven concept, when the sponsor and the arranging dealer already know that there are anchor investors involved, ready to commit capital. And it's a good way to sort of rinse and repeat on proven concepts, but it doesn't allow you to have a differentiated funnel. I think where that comes from is having the proven expertise, presence in the market, commitment of capital, commitment of organizational support, industry contacts, and all of that to give sponsors and counterparties confidence that the less well formulated deals can get done. And so a lot of that comes in moving upstream from the classic syndication process and being a part of either structuring or guiding others to structure investments that serve a particular financial purpose for the sponsor, but also create optimal return and bondholder guardrails for investors. So it's sort of that level of intermediation that's different than passively seeing a stream of deals is one of the key ways that incumbent investors that have been involved in this market can widen the funnel and become aware of a broader range of situations, whether or not they actually come to fruition. So I think a broad array of deals, first point. I think the second point is having a more holistic understanding of the types of financings that arise in structured credit. People can be very good at analyzing documents, the four corners of what's in a long bond indenture, building a waterfall or computing bond cash flows and bond analytics very efficiently with a lot of bells and whistles. But I don't think that's a differentiator. Those are table stakes. Those are already challenging tasks, but they're table stakes. What is the differentiator? A level of commercial awareness about the parties involved, their motivations and incentives, and why a transaction exists in the first place. And that's not something that you get from reading a document. That's something you get from experience in the industry, commercial context, and just a general awareness of the various forms of financing technology that are in play in the market, one of which is structured credit. So that helps identify key linkages between entities, the potential for adverse selection. It assists in determining what's the right price for a level of risk. And none of those things are going to show up in a deal pitch book or a cash flow model. Those things are necessary but not sufficient, I think, for really having an edge in alpha generation of this market.
Now, let's get practical. How do investors make money in structured credit and how do they lose it?
First, just grounding principles. There are four ways to make money. One is duration risk, and that, it comes from the fact that yield curves are generally upward sloping, so you get paid more yield for taking on more duration. And with that comes higher mark-to-market volatility as well as reinvestment risk. Way number two, you make money in active fixed income in general is in credit risk. So this is the risk that you don't get paid back in full. Now that's particularly complicated in structured finance, just given the density of information that one needs to understand to actually do a good job here. And when selecting the right bonds, the benefit of the strategy is obvious. You earn an excess return premium. And when you don't select correctly, back to the old adage, you violate that principle of the best way to make money is not to lose it. We tend to take a grinded out approach, preferring to accumulate many small and medium size wins over time through our credit selection process. The third is convexity risk or call risk. Bonds may be callable. This is speaking about fixed income generally. And that means the borrower can refinance or pay off the debt instrument whenever they feel like it. And that's going to happen generally when they can borrow the money at a lower rate than what's already in place with you as the lender. So just think of the classic example is US mortgages. One borrows money to buy a house, but reserves the right, but not the obligation to refinance it if they look around and think they can get a better deal in the future. That's the lender's problem, right? So that's one way to get paid or to make or lose money is through convexity or call risk. The final fourth one in the sort of classic framework and rubric for active fixed income investing is liquidity risk. All portfolios have liquidity needs. They have investor redemptions for external liquidity needs. They have sector rotation, internal liquidity needs. Anyone who follows the financial press is aware of some of those pressures that are arising in other parts of the market where investor liquidity demand is sort of out of balance with what governing documents allowed in certain types of fund structures, et cetera. But all portfolios have some liquidity needs, and some parts of the market are less tradable than others, and that requires a premium. So those 4 points, duration risk, credit risk, convexity risk, and liquidity risk, are very generic to all active fixed income. I'll add 2 more points specific to structured credit. The first is recognizing the commercial context for when these instruments get created. There's credit demand from a sponsor or the underlying business, and there's a financing technology that has to get married with that allows them to raise capital. What you can do as a creative investor is to move further upstream and help facilitate the financing technology part of that. And that really bridges the gap between commercially viable financing terms and the structural safeguards that investors need. And so that gets you out of the sit by the phone model that I mentioned earlier and being more of an active participant in ideation and deal formation. The second thing is a really immutable commitment to the credit process. Now, one of the four ways in fixed income I mentioned is credit risk. But I think with the complexity and density of terms that are needed to be understood in structured finance, it kind of goes through the point you asked about, Jay, about legal documents and waterfalls. Very, very important. And a lot of investors may not be fully able to not only analyze what is contained in the document, but also think from a historical backward looking perspective or a creative forward looking perspective, in maybe a speculative creative way to think about how the deals may work and incentives may align or not align under exigent conditions.
You mentioned that one of the reasons this is an attractive and compelling sector is that it has superior risk return trade-offs. So let's explore for a minute how investors should think about structured credit relative to these risk return trade-offs that you will get from more traditional, let's say, non-governmental parts of the fixed income market, corporate credit or private credit. So let's just start with the return profile of structured credit versus other opportunities in the fixed income market.
So the good news is as an active fixed income portfolio manager, if you have a holding period of more than, 3 to 5 years, you pretty much know what your return is going to be. It's going to be the yield of the instruments you own less default costs. So that's what we call loss adjusted yield. Now, in the short term, that may not be true, but over a longer period of time, that is. So it helps to start out by thinking about loss adjusted yields across broad investable asset classes and comparing those to what's available in structured credit. So if we just think about the intermediate duration part of the fixed income world, there is there are not many indices out there that are published that track asset-backed securities or RMBS or CMBS. There are a few, but if we just take ABS at the generic index level, there's one that tracks AA to triple B rated asset-backed securities. This one has a maturity of about 3.5 years. It has a yield about 5.75%. Now, if we compare that to U.S. Treasuries, first off, that don't have any credit risk, that's 1.7% above what you would earn there. So pretty significant difference. Now, if we compare that to the corporate bond index, which has some credit risk, but is obviously a bigger, more of a benchmark type sector, ABS, even just at the pure index level, which is still fairly generic, is yielding about 0.6% above the benchmark. So that's nearly double the credit spread of the intermediate duration corporate benchmark. So, if we compare these two, we have one with about a 4.7% yield on the corporate benchmark and about a 5.7% yield on the ABS benchmark. So a pretty significant difference there on two investment grade related indices. Now, if we want to take a little more risk and we look at the highest quality part of the high yield corporate bond market, that's double B rated corporates to just bookend our comparison. We find that double B corporates have roughly the same yield as single A ABS. So this is the part of the ABS index that's single A rated and comprised mostly of first priority senior commercial ABS tranches. So, here we have on the one hand a double B rated corporate bond index, and on the other hand, a subset of ABS, which is single A rated senior and first priority that have roughly the same yield. So I think that's pretty compelling relative value comparison, especially given that we have not even attempted to adjust double B corporate bonds for through a cycle defaults and losses, which will be non-zero. So I think just off the bat, there's a pretty favorable comparison of structured credit to corporate credit right now.
So that was return profile, relatively speaking. And we've already touched on structure and complexity, which probably helps account for some of that difference in the return profiles of the different parts of the fixed income market. Is there anything you'd want to add there about the relative structure complexity between structured credit and, let's say, corporate credit.
Yeah, it's sort of a gradient, and I agree with you. That is a big portion of what you do get paid for. If you start off in the unsecured corporate market, which is most of the investment grade market and some of the high yield bond market, the real focus of credit work is going to be on the borrower's debt capacity, and that's going to be a corporate obligor. In the industry it operates in, their business prospects, debt capacity. There's some, but a finite amount of variation in the structure of these lending terms. Now, if you move into secured corporate lending, which is in some smaller parts of the high yield loan market, as well as almost the entirety of the corporate loan market, in addition to the obligor and industry dynamics, you're looking at assets and protective covenants as well. And then you move up the gradient into structured credit, you have all of those things. Maybe a little bit of a less of an emphasis on the industry and the company because you have assets instead. But now you need to do work to understand payment priorities and how cash gets distributed across the various classes. So in CLOs, you may have a dozen different interest coverage and over collateralization tests in a typical deal, and several dozen collateral eligibility and reinvestment tests. So, is there a lot of overlap with the corporate work? Yes, there is, but the emphasis I think is different, and the specialized knowledge and tools are different. And honestly, that's a lot of what investors are getting paid for is doing the additional work to separate favorable investments and deselecting less favorable investments in this market.
Talk about the comparative investor benefits, if there are any, between structured credit and, say, corporate credit.
What we see in structured credit, in terms of investor benefits, the closest parallel to structured credit is probably in the secured lending world and corporate credit. There are some differences, but I think that's the right jumping off point. And some of the benefits of structured credit are similar, and there are some differences. So, where are the similar benefits with secured lending in corporate credit? We have a pledge of assets and contractual cash flows. That's similar. And that creates some degree of incentive alignment. We have a floor on recoveries if things go wrong. And really, a lot of the credit work we do is similar, which is what are the assets? What are they worth through a cycle? What is the appropriate amount and quantum of debt that is appropriate for that asset value and volatility around that value? And then what are bondholder protections along the way that prevent bad behavior or protect bondholders in the case of bad market conditions or business conditions? Now, where they differ in terms of investor benefits is there are quite a few tests and triggers that will exist in structured credit that will accelerate the debt if things start to go poorly a little bit earlier. So we think that's maybe a differentiating factor. Now, one thing I want to mention is structured credit does not always have these benefits relative to what you'd see in secured lending on the corporate side. Sometimes what we find is in structured credit and ABS, their bondholder protections are, could be weaker on a given deal than what you'd see in the secured lending world. And this is something that comes about from, a lot of collaboration with our colleagues on the corporate debt side in terms of thinking about what an appropriate capital structure should look like for a given proposed, a collateral package and borrower profile. So in most cases, we find that there are good bondholder benefits, the pledge of contractual cash flows and assets, but that's not something that you can take for granted. And this is a big part of what the security review, the analysis and security deselection comes into play.
And one last kind of metric then is compare the risks of corporate credit versus structured credit.
We talked about the higher yield for a given level of credit risk. Well, I think on the risk side, what we've seen is lower default rates historically. So especially at the investment grade level. Part of that is coming from the fact that there's some differences in rating agency methodology. There's difference in the effects of bondholder features like amortization, credit enhancement, over collateralization, some of those things kicking into lower losses on structured credit in bad conditions. And the other thing is, frankly, credit diversity. There's a lot of different assets that are represented in this market. What that diversity allows you to do is take risk across a very wide spectrum of asset types. And so that's not going to help you on any given one deal, but at a portfolio level should allow for better returns on a risk adjusted basis. The other thing that's fair to mention is liquidity. If you look at, let's say, investment grade corporate bonds, that market trades, 50 to 60% turnover a year. So, if the outstanding amount of bonds is X, something like 0.6X will actually change hands and trade every year. If you look at structured credit, that number is something like 10 to 15% annual turnover. So less trading volume. So certainly the ability to move, enormous size is different. But what we've seen over time is with the increasing number of participants in structured finance, and primarily through real money participants like insurance companies and those with sort of sticky capital, the amount of trading has sort of stabilized and the depth of the market has improved. So even though the total headline number doesn't trade that much, it's kind of reflective of the fact that you have a lot of hold to maturity type investors in this market that historically have been comfortable to step in and support the market through a bid side that may be lower than where it was yesterday or the day or the week before. But you don't get these giant air pockets because there is a depth of real money investors in the market. So clearly there is a liquidity difference. You want to get paid for that. But the real density of that underlying bid has probably improved over time.
Thanks, Karthik, for walking us through the fundamentals of investing in structured credit and how we approach it. And thanks to all of you who have joined us for episode 1 of our discussion. I'm Jay Diamond, and I encourage everyone to listen to episode 2 with Karthik Narayanan to learn more about where we are seeing value and risk in the current market for structured credit. In the meantime, visit GuggenheimInvestments.com/perspectives for more of our thought leadership. So long.
Important notices and disclosures. Structured credit, including asset-backed securities or ABS, mortgage-backed securities and CLOs, are complex investments and not suitable for all investors. Investors in structured credit generally receive payments that are part interest and part return of principal. These payments may vary based on the rate loans are repaid. Some structured credit investments may have structures that make their reaction to interest rates and other factors difficult to predict, making their prices volatile, and they're subject to liquidity and valuation risk. CLOs bear similar risks to investing in loans directly, including credit risk, interest rate risk, counterparty risk, and prepayment risk. Loans are often below investment grade, may be unrated, and typically offer a fixed or floating interest rate. This podcast is distributed or presented for informational or educational purposes only, and should not be considered a recommendation of any particular security, strategy, or investment product, or as investing advice of any kind. This material is not provided in a fiduciary capacity, may not be relied upon for or in connection with the making of investment decisions, and does not constitute a solicitation of an offer to buy or sell securities. The content contained herein is not intended to be and should not be construed as legal or tax advice and/or a legal opinion. Always consult a financial, tax, and/or legal professional regarding your specific situation. Forward-looking statements, estimates, and certain information contained herein are based upon proprietary and non-proprietary research and other sources. Information contained herein has been obtained from sources believed to be reliable, but are not assured as to accuracy. No part of this material may be reproduced or referred to in any form without express written permission of Guggenheim Partners LLC. There is neither representation nor warranty as to the current accuracy of nor liability for decisions based on such information.
All investments have inherent risks. The market value of fixed income securities will change in response to interest rate changes and market conditions, among other things. In general, bond prices rise when interest rates fall and vice versa. High-yield securities present more liquidity and credit risk than investment-grade bonds and may be subject to greater volatility. Structured credit, including asset-backed securities, mortgage-backed securities, and collateralized loan obligations, are complex investments and may not be suitable for all investors. Loans are often below investment grade, may be unrated, and typically offer a fixed or floating interest rate.
Stock markets can be volatile. Small and medium capitalization companies may involve greater risk of loss and more abrupt fluctuations in market price than investments in larger companies. Guggenheim Investments represents the investment management businesses of Guggenheim Partners LLC. Securities are distributed by Guggenheim Funds Distributors LLC.